Let's say that you are a beginner in the stock market. You have just entered the stock market and you don't want to take too much risk. You are learning a few things. You have come to my channel and you are liking the content and you want to try it out, but you don't want to take too much risk because you have heard, horror stories of people who burnt their fingers in the stock market. Yeah, some people burn their fingers, some people burn their entire arm in the stock market. But, anyways, assuming that you are a beginner and you are just learning, how should you approach the stock market? So, let's say you come with a capital of, say, for example, 5 lakh rupees in the stock market. Not huge capital, nor is it very, very small. So, you come with a capital of 500,000. So, let's say your portfolio is 500,000, okay, 5 lakh rupees. How should you approach this? Should you trade with 5 lakh rupees? Well, for your first year, what I would recommend is for your first year, what I would recommend is you divide this 5 lakh into two different buckets. So let me explain to you. The first bucket is the first bucket, okay? The first bucket is 100,000 and the second bucket is 400,000. So what you're trying to do is I want you to trade with this amount. I don't want you to trade with this amount. What I want you to do is uh, this amount can be put in a liquid ETF where the underlying is TREPS, which is a debt fund which is traded on an exchange. I cannot name any fund because of regulatory reasons, but you can figure it out. Go to ChatGPT and ask what are the liquid ETFs available in the market. Do some research. Not difficult to find a good liquid ETF where they invest in overnight debt instruments. Okay. So during your first year, what I recommend is 80% of your portfolio should be in that account. It is a part of your trading portfolio, but I want 80% of that money to be in a liquid ETF because what happens is the interest on that part of your portfolio keeps accumulating as a part of the NAV itself. You don't get the interest, but the NAV continues to grow because it is invested in overnight instruments. And the remaining 100,000, I want you to start taking position size of 20-25% because the risk that you are taking on this part is being financed by the interest income or the growth in NAV that you will experience in your liquid ETF part of your portfolio. So, obviously, since you're a beginner, you will make mistakes. You will take trades which you are not supposed to take. So, you could start with 20-25% position size on this portfolio because it's not a very large portfolio. I'm assuming that this is not a very big portion of your total assets in your personal life. So this is 20% of this. So this is not going to represent a huge portion of your overall assets in your life, in which includes your business, your real estate, your gold, your FD, and all those things. So even if you take a 20-25% position size on this portion of your portfolio, you are not taking huge risk in your life. Okay. However, what you are doing is you are conditioning your mind to take a huge position size in the stock market, and which is important as your experience grows and you want to earn profits from the stock market. The game is about position size. It is not about charts and technicals and fundamentals. It is about position sizing. So the fact that you are taking 20-25% position size means that it will force you to only look for stocks where majority of the factors are in your favor. So for example, I would recommend only going for positional stocks. What is the difference between positional and swing? Well, I've already discussed it a million times. A stock that meets at least 7 out of 12 of our fundamental criteria uh, is a stock that belongs to the positional category, all others are swing. So this kind of a arrangement will force you to take trades only in stocks that meet at least 7 out of 12 of our fundamental criteria. So that will build discipline in you from day one. So you're only taking high probability trades, your probability trades in high probability stocks. Only invest in market leaders, only trade in market leaders. Look for green zone closings and in a strong, healthy market, right? So if you do these four things, and of course high relative strength stocks, high RS rating stocks. So if you do these things, you are being conservative in the market, but at the same time, you are taking a huge position size on this portion of your portfolio. So you are conditioning your mind in two ways. Number one, you are conditioning or training your mind to take a big position size in the market, because in the future, as your experience grows, the game is all about risk management and position size. Because by that time, selecting a stock, looking for criteria, that will become second nature to you, right? So you're conditioning your mind to take a big position size without incurring too much risk on your overall assets in your personal life. Second, you are disciplining your mind to only go for high probability stocks, high probability trades. So this will help you. And in spite of that, if you still end up making a mistake, some of that loss that you incur will be financed by the interest income that you earn, which will accrue as a part of the NAV in this portion of the portfolio. Now, some of you might argue that, Rohit, if 80% of your portfolio is in liquid ETF, then what will be the annual return? Well, forget about returns. When you are learning something, focus on acquiring the skill. Returns will come later. Obviously, this will dampen your return for the year on this particular portfolio, but it's not the return on this portfolio that matters. It's the return on this portion of the portfolio that matters. Even if you break even on this portion of the portfolio in an entire year, as a beginner, you are still doing very well because you did not lose any money. And if you don't do if you directly put this money in the stock market without any training, education, it wouldn't take much time for this 5 lakhs to become 2 lakhs or 3 lakhs or whatever, depending on how aggressive you are in your trading, right? So this is an extremely ultra conservative approach where you are controlling your risk, you're conditioning your mind to take huge position size, you're also conditioning your mind to only go for high probability stocks, high probability trades. Now, I also have people coming to me with a portfolio size of like 50,000, right? And there are some people who don't even have like 10,000 rupees to invest in the market, but they still want to test out their learning, whatever they're learning from my YouTube channel. Now, in that case, I don't recommend this approach because the portfolio itself is very small. This is the amount that you can earn from your business or your job or whatever you are doing. So you can afford to take risk. And assuming you have this size of portfolio, I'm assuming you are young, so you have a lot of earning life ahead of you before you finally retire in your 60s, right? So you have an earning life left ahead of you. So you can take a 20-25% position size even on this portfolio. And you should, because the portfolio itself is very small. Here, I don't recommend that you put 80% of your money in liquid case. But if you have a portfolio of, let's say, 500,000, you could do something like this to finance the risk of your stocks with the interest income that you are generating on a daily basis on your liquid ETF portfolio, which is primarily investing in TREPS. Now, TREPS is tri-party repo agreement system, which I have discussed in detail in a 3-part video series. Just type trips or how to manage cash position in your account. In the filter on my YouTube channel, you will find 3 videos where I discuss that in detail. I cannot name the fund, but you will likely find it if you understand how to use ChatGPT. So that would be an approach that I would recommend. It's a very sound, logical approach for beginners, because normally what happens is I students come to me saying that I lost 8 lakh rupees in options trading. Now what do I mean, how do I solve that problem? When you come to the market, right from day one, if you're controlling your risk, you don't have to have a big loss in your account before you become a professional trader. Generally, people spend a lot of time incurring losses 5 to 6 years before they actually become professional positional stock traders. But you don't have to do that because the knowledge is already there. Mark Minervini has written books. O'Neill has written books. There are so many interviews nowadays on YouTube. Plus, you have my channel. I have discussed a lot about Mark Minervini and O'Neill's system. I consider both of them as my mentors. I continue to follow their books, their work, their interviews. I learn from them. So there is so much learning material. There is Chat GPT. You can actually have a conversation with Chat GPT regarding this system, what you should be doing, what you should be avoiding, things like that. Plus, on top of that, if you are managing your risk conservatively, I don't think this is a wrong approach. This is for first year. Second year, you could change this percentage. This is 20-80%. Second year, you could go with 40-60%. Third year, you could go with 60-40%. Maybe by fourth, fifth year, the entire amount will be invested in the stock market because now you know how to manage the risk. Or after 1 year itself, if you feel confident of how you manage this portion, in the second year itself, you could move this entire amount to your equity portion of your trading portfolio. That will solve the problem. You don't need to keep learning for 3 years. Even 1 year of learning is fine. Even 6 months of learning is fine. If you feel confident after 6 months, you can move this portfolio into your equity trading portfolio. Well, the entire amount is in your trading account itself, but the instrument is different. That money can be used to finance the risk that you incur, so that net on this you won't be at a loss. At the end of the year, you won't. There is a good chance that you won't be at a loss if you use a stop loss. Okay. Now there are people in the market who feel that like real men don't keep a stop loss. Well, if you believe those kind of things, then I have no prayer for you. You have to trade with a stop loss. You have to manage your risk. Otherwise, you are inviting disaster. Right? There are stocks which I have seen which collapsed 30% in a single day. Today is 24th of July. I saw one stock today collapsed 30% in a single day. I cannot name the stock, but you can find it out from Market Smith. So crazy things can happen in the market. So you have to control your risk. You can't play around in the stock market. Just like you spend 4 years to become a doctor, to become a lawyer, similarly you have to spend some time to become a trader. This is a profession. You have to treat it as a business. You have to treat it as a profession. So I'm sure you will manage your risk properly if you are a beginner. Spend more time learning than trading if you are a beginner. As your experience grows, spend more time trading than learning gradually. Thank you so much.